Hello and welcome to the latest episode of Damien's Midweek Markets, the show where I talk about what's going on in investment markets and what to look out for in the days and weeks ahead. Now, last week we had the US Federal Reserve start to put a bit of uncertainty into markets, not intentionally. If you recall from last week's show as I made it, the US Federal Reserve the previous night had stated that it didn't believe there was going to be quite the V-shaped recovery in markets that the equity markets were actually pricing in. And at the time I made the video, it was quite interesting because the market has started to show signs of weakness. If you recall, the S&P 500 was up around sort of 3,200 level, just above, and it started to pull back. It started to test the sort of 3,200, then the 3,100 level. Now, interestingly, that market or that day started to unravel even more. What we saw last Thursday was the market accelerate to the downside, and by that I mean the S&P 500 started to test the 200-day moving average and even the 3,000 level on the S&P 500. It came out of nowhere. The Dow Jones was down around about 7% on the day. The FTSE 100 broke all the way down to the 6,000 level again. So we got to a point where panic entered the market, but it really accelerated to the downside. And we had a lot of the bulls suddenly going very quiet and not saying too much as they panicked and wondered whether we were going to see a repeat of what we saw in February. Certainly the VIX, the fear index in the market, spiked. If you remember, it was touching the 200-day moving average, which was obviously a good sign for those who are bullish on stock markets, particularly in the US. Well, that rocketed higher and it actually broke above 40. So that showed you the level of anxiety that entered markets. Now, eventually, the stock market started to find a bit of a floor. So while the equity markets were tumbling, bond markets were actually rallying. If you remember, the yield on the 10-year US Treasury rallied very strongly in the previous week or two, and it was up around about 0.9%, but it actually fell all the way down to about 0.6% during this period of uncertainty, and gold continued to do relatively well. To compound the anxiety was this idea that we may be getting a second wave in the coronavirus outbreak around the world. Particularly at the moment, it seems like China is having some problems, but also certain states in the US are showing signs that the number of coronavirus cases are picking up. So we then started to get an interesting rotation go on. So if you remember in the last few weeks, we had the equity markets rotate from some of the growth-orientated stocks, some of those stay-at-home stocks, into the cyclical sectors, so things like financials or even retailers. So I'm talking about offline retailers. That started to unwind actually because, and going in the other direction, because people suddenly started to panic that we were all going to end up in lockdown again. So the likes of Amazon did well, and any stock that was remotely linked to the stay-at-home period that we had while we were in lockdown. So it meant that big tech did really well last week. And so if you held technology stocks, US stocks in particular, but tech stocks, and you also held treasuries or gilt, then your portfolio did very well in the last week while the rest of the market sold off. You actually probably would have made money. So where are we now? At the moment, the market has started to try and rebound. And that is because the Fed has actually come out again and said something slightly different. Now, the Fed has come out and told the market that it's planning to buy certain types of corporate bonds. Now, we already knew this. This was announced a couple of months ago, but they gave a bit more detail to it and actually talked about certain single corporate bonds that could be bought and the idea they'll build an index that they're going to buy. Previously, they were buying ETFs of treasuries and high grade corporate bonds, but now they are going to expand that operation now. And so this is in addition to what they were doing before. The market loved that. And so that put a bullish tilt on things. So what we saw is equity markets pop and bounce a lot higher. As I look now, the S&P 500 is up around 3,124. The FTSE 100 is around 6,250. The VIX is about 33, 34. And the US Treasury yield is now, it's up back towards 0.75%. So this week has been basically bookended by the Fed spook in the market and then the Fed reassuring market. So perhaps this is what we're going to see going forward. Every time we see a bout of volatility. And I think this last week is a very good example of what we could see going forward. That is periodic spikes in volatility. And we may see further downside, but also upside. It's going to be a bit of a ride that investors are going to have to get used to. But we're probably also going to see central banks coming into the market with new measures. And also in America, there's talk of more fiscal stimulus, which the market also likes. But for UK investors, they've also seen the pound start to weaken. If you recall, the pound rallied and broke above the $1.27 level. Now, it's actually broken back down towards the $1.25. It'll be interesting to see if that holds, because if it breaks down below sort of $1.25 level, it could go a fair bit lower and maybe head towards the $1.22, which is obviously good for UK investors when they're holding overseas assets denominated in dollars. It gives it a nice sort of currency boost. So we've got to see what happens. So at the moment, the key things to keep an eye on are going to be economic numbers coming out. It's still going to be a lot around what the central banks are going to be doing. Look out for any fiscal stimulus measures, particularly in the US, but also those coronavirus headlines. It does seem that the US-China trade war is taking a bit of a backseat for now, but who knows how long that will last. And obviously, in the coming months, we're going to start to head towards the US election, which always causes a bit of volatility. So it's something else to look forward to in the coming weeks and months. So that is it for this week on Damien's Midweek Markets. As ever, you can contact me. Damien at moneytothemasses.com is the email address. Money to the Masses with the number 2 is a Twitter handle. Of course, I'm on Instagram. I'm also on YouTube. Please do make sure you subscribe to our YouTube channel. And of course, please also join our Facebook community at facebook.com/groups/money to the masses.